$577 million. That's the figure detailed in a will signed 2 days before a death officially ruled a suicide. 2 days. And for nearly 6 years now, one question has remained without a clear answer. Where did all that money actually come from? Because here's what we know. Jeffrey Epstein was presented to the world as a high-powered financier, a man who moved the wealth of the ultra-rich with disarming skill. Except behind that facade, he had no university degree, no financial advisor license, no CFA, no Series 7. He billed tens of millions in tax advice without being a lawyer or a certified accountant. Hundreds of millions in wealth management without the required credentials. And yet the money kept coming, more and more of it, and almost nobody seemed to be asking the right questions. Tonight, we followed the money trail, not the scandals, not the famous names for their own sake, the financial mechanics, the structures, the flows, because that's where the real story lives. Let's start at the beginning. In 1976, Jeffrey Epstein is dismissed from his position as a teacher at the Dalton School, a prestigious private academy in Manhattan. He is let go for poor performance. That detail alone is remarkable, because he was teaching there without even holding a college degree. But the story pivots. Instead of fading into obscurity, he lands a job at Bear Stearns, one of the most powerful investment banks on Wall Street. He starts at the bottom, running errands and handling small tasks for floor traders. He learns fast, remarkably fast. He develops a particular talent that has nothing to do with financial mathematics. He knows how to talk to the wealthy, how to charm them, flatter them, and manage their complex affairs with an ease that unsettles people who have spent years acquiring credentials to do the same thing. In just 4 years, he goes from entry-level assistant to limited partner at the firm. To put that in context, graduates from the world's top universities do 4 consecutive internships, hoping to climb that kind of ladder. He did it without a degree, in 4 years. Wall Street operated differently back then. Less regulated, less competitive, and far more relationship-driven. Someone who could organize an unforgettable evening for a wealthy client could bring more value to a firm than a PhD quantitative analyst. And Epstein clearly excelled at that art. By 1980, he was earning $200,000 a year. In the dollars of that era, that was a fortune. Had he simply maintained that trajectory, invested wisely, and built a stable career, it might have been enough to account for his eventual wealth. But of course, none of that happened. In 1981, he left Bear Stearns. Or more precisely, he was pushed out. The exact reasons were never officially confirmed, but several factors converged. He had reportedly lent money to a friend to buy stocks, violating internal firm guidelines. He was alleged to be having an affair with an office secretary. The Securities and Exchange Commission had him in its sights for a violation of Regulation D, meaning he was trying to sidestep public investment registration requirements. On top of that, the firm was under investigation for insider trading, a proceeding in which Epstein would have to testify as a witness. In that testimony, we learn, almost by accident, a revealing detail about his first criminal conviction. Long before his most well-known crimes, he was prosecuted in the United Kingdom for unlawful possession of an antique sword. It was a minor conviction on the surface, but one that reveals a man who seemed to operate constantly at the edge of what was legal. Despite this chaotic exit, he maintained productive relationships with Bear Stearns and its executives. We will see why that connection matters later. In the immediate term, he set up his own operation called International Asset Group. On paper, it was a financial consulting firm. In practice, it recovered embezzled assets, retrieved funds for wealthy clients, and navigated the gray zones where law and finance overlap across multiple jurisdictions. One of his clients at that time was Adnan Khashoggi, a notorious middleman in the Iran-Contra affair, one of the defining geopolitical scandals of the Reagan administration. He was a man who carried a fake passport. Later, when Alexander Acosta, the federal prosecutor in Florida, who negotiated Epstein's famously lenient plea deal, was questioned about that leniency, Acosta said on the record that he had been told Epstein belonged to intelligence and to leave it alone. We draw no conclusions here. We present the facts. The facts, lined up one after another, form a picture that is difficult to dismiss. After 6 years running International Asset Group, he joined Towers Financial Corporation, a debt collection agency. The model was straightforward. Buy debt cheaply, such as medical bills and unpaid obligations, then pressure debtors into paying the full amount. As a senior consultant, he earned $25,000 a month, roughly $70,000 in today's money. A comfortable salary, but still nowhere near enough to explain the hundreds of millions he would eventually accumulate. And in 1993, the structure collapsed. Towers Financial filed for bankruptcy. Investors lost an estimated $450 million. At the time, it was the largest Ponzi scheme in American history, a record that would not be broken for another 15 years, until Bernard Madoff. Epstein was a central figure at the firm, presenting himself as the protege of its founder, yet he was never charged in connection with the fraud. Let us take stock of where he stands at this point in his career. 1 criminal conviction. Dismissed from a teaching job he was unqualified for. SEC complaints. Connections to an insider trading investigation. Ties to one of the murkiest figures in 1980s geopolitics. An involvement in the largest Ponzi scheme of the era, without a single charge. It is at precisely this moment that he decides to become even more opaque in his business dealings. He creates J. Epstein and Company, a wealth management firm with a single entry condition. You must be a billionaire, not a millionaire. And this is where the real financial flows begin to take shape. The first major identified client is Leslie Wexner, the billionaire co-founder of Bath & Body Works, and a major shareholder in brands including Abercrombie & Fitch, Lane Bryant, and Victoria's Secret. Wexner becomes a client of Epstein's from the moment the firm opens, and their relationship quickly extends beyond anything resembling a standard professional arrangement. Over 15 years, Wexner pays Epstein approximately $200 million in fees for tax advice, estate planning, financial management. $200 million. For an average of $20 million per year, Wexner could have built his own in-house family office, hired a full team of specialists across every relevant discipline, and still had money left over. The sum is so staggering it cannot help but raise questions, and the relationship between the two men goes well beyond the numbers. Epstein's famous Manhattan townhouse, valued at tens of millions of dollars, was officially owned by Wexner for over a decade while Epstein was living in it. Wexner, as the legal owner, came and went freely. The door, however, bore the engraved letter J. The second major identified client is Leon Black, founder and former CEO of Apollo Global Management, one of the largest private equity firms in the world. Black is not a financial novice. He is one of the most sophisticated operators the industry has ever produced. Yet between 2012 and 2017, he paid Epstein at least $158 million, according to an ongoing investigation by the Senate Finance Committee. More than $30 million per year. And the question that naturally follows is this: what could a financier of that caliber possibly find in Epstein's services that he could not obtain through his own firm, with his own teams, at a fraction of the cost? One possible explanation, perhaps the most benign, is that these fees reflected aggressive tax optimization strategies. Epstein was clearly comfortable operating in offshore structures, in tax havens, in multi-layered arrangements designed to allow money to travel across jurisdictions without leaving obvious traces. His own firm had been rebranded as the Financial Trust Company and relocated to the U.S. Virgin Islands, allowing him to claim local economic development incentives. On all of his fees, he paid an effective tax rate of approximately 4%. That was less than a tenth of what he would have owed if he had been based in New York. The other explanation, considerably less benign, is that these payments represented something else entirely. Arrangements. Services that had nothing to do with tax planning. We draw no conclusions. We describe the structure. In total, aggregating all identified revenue sources, Epstein and his firm collected approximately $488 million in traceable fees. Clients including a member of the Johnson & Johnson founding family and the hedge fund Highbridge Capital round out the picture. But here is where the accounting stops adding up. His 2019 will described assets worth approximately $577 million. Only about half of that amount was invested in cash flow generating assets. The other half was tied up in real estate and less liquid structures. Several of his major investments had simply imploded. Take liquid funding, an offshore hedge fund registered in Bermuda, created in 2000, with Epstein as chairman. This fund came to light through the Paradise Papers, a massive leak of documents from an offshore law firm, published by the International Consortium of Investigative Journalists. Those documents revealed that Bear Stearns, his former employer, had taken approximately 40% stake in the American holding company that controlled this fund. The fund itself managed around $900 million in assets at its peak. Those assets were primarily composed of swaps on mortgage-backed securities, a structure rated AAA and considered revolutionary financial engineering at the time. If you have any memory of recent financial history, you already know where this is heading. In 2007, while Epstein was serving his infamously light sentence in Florida, liquid funding was collapsing under the weight of heavily leveraged derivatives and toxic mortgage assets. Less than a year later, Bear Stearns itself, the firm where Epstein had gotten his start on Wall Street, would disappear in the vortex of the global financial crisis. His personal stake in liquid funding likely represented more than $50 million. Gone. And then there are the ongoing costs, the lifestyle, the private jets, properties scattered across the world, maintenance costs on real estate worth tens of millions, and above all, the lawyers. Court records indicate that Epstein retained more than 75 attorneys over the course of his life, including some of the most expensive practitioners at the American bar, billing several $1,000s per hour. When you add it all up, investment losses, operational costs, lifestyle expenses, and legal fees, you arrive at a figure that comes uncomfortably close to the total of his traceable revenues. Which means that to reach the $577 million documented in his will, there had to be other income streams. Undocumented flows, or perhaps assets deliberately held outside conventional financial systems. And that hypothesis is not unfounded. The Senate Finance Committee established that accounts held by Epstein's firm at several major Western banks recorded more than $1.9 billion in total transactions, nearly 4 times the amount of already documented fees. Those transactions also involved banking institutions, now under international sanctions, adding yet another layer of unanswered questions about who his clients really were and what they were actually paying for. This is where certainty ends, because that is the real problem. Epstein operated out of the U.S. Virgin Islands. He used shell corporations in jurisdictions with strict banking secrecy laws. He moved between legal regimes with a fluency that suggests either a deep personal knowledge of these systems or access to resources that allowed him to exploit them. And the public documents available remain massively redacted. Entire pages blacked out, paragraphs erased, names hidden behind solid rectangles of ink. And behind all of this lies a broader financial reality that extends well beyond Epstein's individual case. What his story illustrates is the ease with which money can flow through offshore structures that are opaque by design, jurisdictionally complex, and deliberately built to resist any coherent reconstruction. The majority of funds that move through these tax havens are not connected to crimes. They are connected to a desire to minimize tax burdens. But when the best possible scenario is aggressive tax avoidance, it gives you a sense of what the worst scenarios might look like. $577 million. A will signed 2 days before a death that continues to generate questions with no satisfying answers. A network of offshore companies, bank accounts, and unexplained cash flows. And behind the numbers, a global financial system opaque enough to make all of this not only possible, but in large part entirely legal. This is not a story about one man. It is a story about a system.